You ever look at a company's results and just think, wait a second, that doesn't add up? Well, that's exactly the story with Qian Hu's latest financials. It's a classic paradox. Their sales actually went up, but they somehow ended the year with a loss. So how on earth is that possible? Okay, let's dive into this and figure out what's really going on beneath the surface.
So here are the two numbers at the heart of the puzzle. On one hand, you've got revenue for the financial year 2025, which nudged up a little bit to almost $72 million. That seems okay, right? A little growth is better than no growth. But then you look at the other side, and the bottom line tells a totally different story. A net loss of $751,000. That's a huge swing from a profit just the year before. So what is driving this disconnect?
So here's how we're going to break this all down. We'll start by really getting to know Qian Hu's business, then we'll dig in and uncover the real story behind these numbers. After that, we'll look at their big bet on technology, check out what the future might hold, and then we'll wrap it all up with the key takeaways for any investor watching. Okay, first things first. To really understand the results, we have to understand the company itself. You see, Qian Hu isn't just one single business. It's actually built on 3 different pillars, and each one has its own unique story to tell this year.
Now, what's really interesting here is how their revenue is split. You can see the business is pretty much dominated by 2 main segments: accessories, which makes up about 47% of sales, and then their core fish business, coming in at almost 43%. The plastics division, it's a much smaller piece of the pie, only about 11%. Now keep this split in mind, because the performance of those 2 big segments is really the key to solving our paradox.
All right, now we're getting to the heart of it. We're going to look at how each of those segments actually performed, and you'll see it's really a tale of good news and bad news that explains how their total sales could creep up while their profits just fell off a cliff.
This table really lays it all out, doesn't it? Just look at that change column on the far right. You see red, negative numbers, all the way down. Profitability dropped in all 3 business segments: fish, accessories, and plastics. And to top it all off, their unallocated corporate expenses, the central cost of just running the company, also went up. It was basically a perfect storm. Lower profits coming in from the businesses and higher costs going out at the corporate level.
So let's start with the fish segment. The good news is sales were actually pretty healthy, growing by a solid 4.5%. People are still buying fish. But the bad news is that profits fell by over 10%. So why? Well, it was a shift in what they were selling. The growth came from activities with lower profit margins, like handling transshipments, which is basically just acting as a middleman for other people's fish, and a different product mix that just wasn't as profitable. Now, for accessories, the company's biggest segment by revenue. And this right here is a perfect example of why you can't just trust the headline numbers. The reported profit fell by a massive 50%. That looks terrible, but here's the twist. The company says that if you ignore the noise and look at the actual day-to-day business, their operating profit actually went up a little bit. So, what caused this huge discrepancy?
The answer is right here, a one-off event. You see, in the previous year, FY2024, the company got a big payment of $700,000 from the government in China. That was a one-time thing, a nice little boost that made the 2024 profit numbers look unusually high. Without that extra income this year, the comparison just looks awful, even though the core business was doing okay. So the crucial takeaway is that 50% drop isn't nearly as bad as it looks on the surface.
The story for the plastics segment is, well, a lot more straightforward. Their profit fell by about 12%. There were no one-off events or weird comparisons here. This was a simple case of rising costs. Higher prices for raw materials and increased operational expenses just squeezed their margins, even though their customer base was stable.
So with profits getting squeezed from all sides, you have to ask, what's the game plan for the future? Well, they're not just sitting around hoping for costs to come down, they're actually making a pretty significant bet on technology to fundamentally change how they operate.
And you can see their strategy crystal clear in the words of the CEO himself. He's pointing to the integration of a company they bought called Aquarium and a bigger push towards digitalization. The whole goal here is to use technology to get more efficient, get better control over their operations and data, which should, in theory, help them manage those rising costs we were just talking about. So what is this Aquarium thing, anyway? Well, it's basically a tech solution for fish farming that uses artificial intelligence and the Internet of Things, or IoT. The strategy is to use this tech to make their fish farms smarter. This should boost how much they can produce, make harvests more predictable, and, most importantly, crank up their efficiency to finally get those operational costs under control. It's a direct answer to the profit problems they're facing.
A technology pivot sounds promising, right? But it costs money.
And that brings us to the company's outlook and how they're trying to manage their finances to pay for this new strategy, all while navigating a pretty tough economy.
From an investor's point of view, this slide is key. The company decided not to pay a final dividend this year, and while that's never fun for shareholders, the reason behind it is strategic. They're holding onto their cash to reinvest back into the business for things like renewing land leases and, of course, funding those tech projects we just talked about. They are clearly playing the long game here.
At the same time, check this out. Their debt-to-equity ratio has also climbed, going from 0.38 up to 0.49. Now, all this metric really shows is how much debt a company is using to finance its assets. So an increase means they're taking on more debt. This isn't necessarily a red flag, it's helping fund their growth, but it does increase the financial risk, and you can bet it's a number investors will be watching very, very closely.
So, the ultimate question is, can they pull it off? Can these big investments in technology and a cautious approach to cash get them back on track? Well, the company itself is optimistic. They've gone on record saying they expect to get back to being profitable in the next financial year.
All right, let's pull all of this together into a final summary. For anyone looking at Qian Hu right now, it's a classic balancing act between the potential opportunities that lie ahead and the very real risks they're facing today.
On the plus side, the opportunities, demand for their core products is still strong. Their big bet on AquaEasy could be a game changer for efficiency, and they're focusing on what sells. But on the risk side, the economy is still shaky. Their debt is rising. Suspending the dividend shows that cash is tight, and those corporate expenses need to be brought under control. The big question is whether their tech-driven growth strategy can pay off before the risks catch up. It's really a turnaround story in the making, and this next year is going to be absolutely critical.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.